Okay, folks, welcome to Market Trends. I am David Russell, VP of Market Intelligence at TradeStation. It's great to be with everyone. As usual, if you want to go to TradeStation.com, go to the Research tab on the top, and then the Insights menu option. It will take you to the Market Insights blog. And there, as usual, we have a blog post with the main points we wanted to cover in today's webinar. I'm just showing you some important disclosures. Remember, all the ideas and concepts discussed are for educational purposes only. Nothing is a recommendation aside from using TradeStation. Hope I can say that. Always a privilege to be here speaking with you guys and be able to show you the power of our award-winning platform. We also have the zip file, which is in my the blog post, and we'll quickly show you that. All right. So this is our, all right, so basically you want to go to TradeStation, go to Research, Insights, and then the blog post with the Wall Street symbol is kind of where you want to be looking. This one, this Wall Street sign. So as we look at this, we're kind of just more or less proceeding as expected of the S&P 500. The main thing, we always look at kind of the key points about the market here. And there's been a level that I've been watching. It was a nasty reversal level. I remember April, it was right after my daughter was born. I remember late April of 2022. And we went up to 45.13, got rejected. And that's been to me kind of a point of reference. And today, hit 4,500. I've heard people like Katie Stockton talk about 45.10, but we're getting kind of close here to the level we're looking for. So there's really very few bearish signals. And, above it, we break above this level, the level from March of 2022, which was that peak immediately. If you look back when the market kind of, we look back here to let's look at this blog, MT blog chart. Let's just look at a good one. So if we look back, it's pretty interesting. To March, this level here of late March, that was our first attempted rally. That was actually the first Fed rate hike, and people thought, oh, the Fed's done, rally, and then the bear market begins. So in my view, this is the level I've been watching, and that's the level that is we're getting close to here. But now, then above that would be this high from March. So kind of watching that, and it's a point now where in many ways the real story is the real diminution of volatility, the kind of collapse of the VIX. So we go to MT main. Or by the way, this is so if you're in this article and you go to the downloads, it will bring you to a zip file that includes these items. You want to import these ELD files first into your TradeStation platform. Then you can use the you can do them here by type. You can see you want to import all these in order to use your workspaces. So right now we're in an environment where volatility is coming down, and I have always had a kind of concept, and it's not a watertight strategy or but it's a basic kind of sense of the market, which is the market goes through periods of volatility and correlation, like the whole market crashes or the whole market rebounds, and in those moments you get big moves out of the indexes, and in those moments it can make more sense to focus on trading the futures or the big ETFs or things like that. Then as the VIX come, and then what usually happens is the market crashes and there's a ton of volatility, the market rebounds, and then the indexes all move together. You need a big index. But then you get to a point after the market has some big, 1 to 2% moves to the upside, which we've now had, you just stop moving and the VIX goes down, and then you're in your stock picking environment. And now this is how also a lot of risk management, like, for hedge funds and stuff work. When the VIX goes down, they take more risk on individual stocks and vice versa. That's why hedging, people talk about futures and ETFs and indexes, because in a moment of volatility, the indexes move together. So it's essentially what we're kind of looking here. And I think we want to apply that. We think about applying that to our own trading, which is essentially when the VIX goes down and we see this sort of environment of low VIX, smaller moves in the index, that's when people start looking at individual stocks, like the trade desk. Boom. It wasn't in the NASDAQ, but now it is. Now, remember, this was the one we flagged last week using our non-index screener. And that's well, it will soon exit that scan because it will soon be in the NASDAQ 100. So we were talking about this last week, right back here in our last market trends or somewhere around here, when it basically pulled back, and we were saying, let's find stocks that have rallied, that are not in indexes, that, plausibly one day may become, bigger companies. And this is the point now we're in something of a sweet spot for growth investors, because you have these names like the Trade Desk or Palantir or a bunch of these other names that have now demonstrated. Opera, we've talked about. We talked about your fintech real estate companies like Redfin 2 weeks ago. Look at this. So this is what we've been talking about here. As volatility comes down and people gain confidence in the market, we see this sort of shift towards smaller, more kind of random names, and maybe not more random, but smaller names that are not in indexes. That's really the key thing. So this is a sort of widening, and this is kind of what we would, kind of expect to see as we get more of a kind of benign environment from the Fed, from interest rates, this concept of a soft landing, which is very much now becoming more of the mainstream. So for example, like we talk about Trade Desk. Now there's a pattern that I want to point out. This pattern's been working. The pattern is a big growth stock crashes last year. Let's just go to a weekly here of Meta. This is Meta we're looking at. It crashes. It goes to the 50% retracement and pauses, which is what it did right here around 240, and then it continues. Tesla has done the same thing at different points. There was a level where it actually right around here rallied, it paused, then it continued. Trade Desk also retraced. It went down. This was the 50% of its peak to trough. November of 2021 in many ways was the peak of the kind of QE pre-hiking, complacent frenzy to the upside. That was the peak. Goes all the way down to this level. You do a 50% retracement of that, and stocks have been pausing at that level, and then they've been continuing after a pause. And that's what we're seeing here. So this pattern's been in effect, and it's something that I think, can be applied. Another one, Salesforce.com, similar sort of thing. We had talked about this. We did a trading view idea on it, and it paused. And then out of nowhere, they announced they're raising prices, continues to the upside. Now, this is a growth stock, and it's a member of the Dow. Interesting overall, but it's ascending wedge. We had done this. If you guys don't know, let me just share this link very quickly with you guys. If you go to Trading View, you guys know where I post these Trading View ideas. And I'll tell you, some of them I tried to be more cautious. I thought the market might pause a little bit more. I wanted to have some negative ones up in case things, pulled back after CPI. So I put up things like Intel and Starbucks, and those did not in any way move to the downside. I mean, this is an environment where it's been hard for things to really have much downside, unless you're in healthcare. So I'm going to point out some things like Intel, not great. Starbucks, not great. But anyway, these are the ideas here that we have, and we did Salesforce right here. Look at this pattern on Salesforce. We had identified the 50% retracement, the tight squeeze, volatility squeeze, and then boom. Actually, right now I'm working on another chart. This is kind of sloppy, but trying to get this chart to work. I have to fix it. But here's the key things: advanced micro devices rally from low of May to the high of June, pulls back, almost hits the 50% on the pullback, and then it stabilizes. And if you actually add Bollinger bandwidth in here to a volatility measure, you're going to find there's a tight squeeze right now in AMD. We have an ascending triangle. We touched the 50-day 2 days ago. We held, and obviously advanced micro is a noteworthy growth stock. I've been wary of the semiconductors, and that's been one area where my my fear has been unwarranted. But it's interesting. Look at this low here from May 25th. Go down. You see how that was support early June, comes down, resistance early July, and then here we are pushing again. But now, this is the one right now that's popping up to me as being, potentially worth taking a look at. We actually have that in here under our patterns and signal section. Advanced micro devices 50-day triangle near the 50-day. It's pretty interesting. Look at Shopify. We put this one up, same thing, and then today, I mean, it just exploded higher. But it's interesting. This is a bigger triangle, but you can see here that we have higher lows on the weekly. This daily chart, but these are weekly lows. It goes down to the 50-day and then breaks out. Also, you'll notice how it just plays with these Keltner channels. So these patterns are some of the things we've been watching. But I want to point out right now, if there's anything that kind of springs to mind, AMD is kind of on my is kind of near the top of the list. All right, so last week, let's take a look at. We start with our MT main workspace. We go to key ETF. So we look in the last week, we can actually see energy was doing pretty well. The energy was the top performing single sector, and we had been talking about energy in many ways had a lot of negativity in it, and the fundamentals are at a point now when if we don't have a recession, it's hard to be to think that energy stays lower. A few weeks ago, we also looked at a pattern of a falling wedge. If you look back at our old market trends, if you actually go to the market trends thing we did today, our blog today, and you look, if you just click on market trends here, like open up a new window and you look back like I think 2 blogs ago, we did this falling wedge in crude. There it is. And so, from my perspective, I mean, you can call it a few different things. The key thing is it tried to break this support. It failed, and now it's squeezing higher. And wanted to just point this out, that this thing we noticed in energy, this could be something to be aware of, and this could be something that has staying power. All right, just looking. All right, when we look at the CPI, like yesterday, the CPI was, wait a second. Here's the one we're working on today. Let me just make sure I cover the key points in order here. All right. This thing here also with my blog chart, wanted to point out, was the advanced decline line, which you can actually get. We actually go to empty breadth. Let's do that. That one you guys have. So here we look at SPY. This is one of the workspaces in the zip file. This is basically a series of breadth measures. And we've been heavily focused on this thing of the 20-day versus the stocks above the 20 and the 50-day. It gave a bearish signal for a few days, or not even bearish, but a non-bullish signal, and then it immediately turned positive again. So I mean, this is, I think, a point here where you have to also kind of realize there's a point where the signals themselves are not, nothing is going to be always 100% perfect. I mean, it's been pretty clear signal. If you look at the MT3 data crossover strategy, basically this is one that has identified some longs. This is a long went there to there, it closed it, and I think it might have reopened it. This is a little bit messy, and I think the thing is all these things are concepts, and you're working with stuff on a daily chart when it's so close together. You got to be careful trying to be too precise about it. But the key thing is it really hasn't been able to stay in a non-bullish fashion. And if both of these stay above kind of 400, you're basically saying that 80% of the S&P is above its 50 and its 200-day moving average. And that's just an environment right now where it's it's not, there's nothing bearish in that when you consider that. Let's go back to our MT breadth. This shows the advanced decline line, new all-time high yesterday and today. Lots of these green line here shows lots of stocks hitting new 52-week high. So, there's really nothing here that gives a bearish story. I mean, I'm looking, and I am really not finding any. I don't see a single bearish signal, and I don't want to be complacent, but I mean, the biggest bearish signal you might have right now is the fact that the VIX is at is near a low, and it's not going a lot lower. And you can maybe say the VIX is due for a little volatility pop or something like that. But to me, that's just kind of, that's not a signal, that's a possibility. So like I said, at this point for me, it's more a question of looking for individual names are going to start to come to life. And like I said, AMD, of the big names that a lot of people like to look at, that's the one now that was kind of jumping highest at the top of my list. Also interesting. All right, this is something I do on TradingView just to share with you guys. So this is really fast. 10-year, 2-year yield curve. When this is the inverted curve everyone complains about. If you go back to the early 1980s, which I don't think we have on this chart, I mean, you're talking a serious curve inversion here, but this is a weekly chart, but we're coming off those lows. And so to me, what's interesting, if you look at US 02Y, this is the 2-year note. 2-year note yield hit 5 and then basically died, reverse. It could not hold above it. And in many ways, this was, I never, I mean, I'll be honest, did not expect it to go that high, but I think my read of the inflation data was correct, which was just that this inflation thing is fading now, and it all comes down to shelter. This has been pretty easy to anticipate, and I've talked about it a ton, and it's true. I mean, there's other things I say that don't work out, but this is one where when you're right, you got to just kind of, accept it. And I think the market never really, I think we just got to a point where there was a zombie drift sometimes in price, and then people wait. You just have to touch a level. You have to say you did it sometimes, and then people will go the other way. But, we're seeing here a pretty clear sort of, rejection of higher rates. And as the 2-year starts to kind of drop, Paul Tudor Jones several months ago said that when the 2-year starts to drop, that will be your signal for the market to rally. Well, the market's been rallying despite that. And I think in many ways, everyone is kind of anticipating the thing that needs to be seen. And, I almost feel like we might be a spot here where we rally until the Fed cuts rates, and then it will already be priced in. So, I mean, you got to realize this market, the Fed now is giving visibility they didn't give in the 90s or even during the financial crisis with these dot plots and everything. So you're in a weird spot now where people have more visibility. There's all these people who say, oh, well, the market won't rally until the Fed officially cuts rates or whatever. But you got to realize that the Fed is now basically telling you what they're doing in a way they didn't do before. So the market is not surprisingly looking ahead. So we can see here that with these yields coming down, look at the 10-year TNX, it's TNX, I'm sorry. So the TYX. And, we said this also, we were talking about how basically the 30-year was not going back to its old high. And that was our signal, because I believe the 30-year is actually the good signal, because the 30-year is a little thing just really quick, is if you look back in 2020 when the market, at this point in March of 2020, at the bottom of the kind of, pandemic, you basically had the 30-year made a low, and then it started making higher lows. But if you look at the 2-year, US 02Y, it basically back in 2020, it kept going down, and the 10-year also, I'm pretty sure, made new lows, or it didn't, maybe not quite as low, but it took longer. The key point is those longer yields have been telling us that, we're kind of near the end here. So that's important for many reasons that I think we know. And I think it's also, I'm sorry, I don't have this in my notes, but I mean, regional banks, I think we have to realize that this is an area where people might just view regional banks as a way to go bullish on yields coming down, because it was a pretty clear, tail wagging the dog effect of high yields killing the banks. Then, you don't have to be a genius to see that kind of relationship in place. And it seems to be kind of playing out. So with the banks coming out and the financials and stuff soon, I mean, that to me is in an area that I think is worth, staying focused on. All right. I'm going to get rid of this because this is old. I'm confused. All right. I want to really quickly share here. I did an article early in the week about something that was happening in Apple. It was just kind of interesting. It wasn't a trade that necessarily something people want to follow. I'm pretty sure I was looking at the options activity, and I couldn't be totally sure. I was at 75% sure that this was a put credit spread. So they were going out to August 4th, the first Friday of August, and they were selling the 180s and buying the 170s. Let's take a look here at Apple. And they were selling this put here and buying this put here. So why would you do something like that? Well, it's not hard to, see that Apple has had a good run. It's extended. Say you like Apple and you're like, I want to own it. I believe in the name. With a spread like this, they basically stood to, collect, a little more than $1. But the thing is that say it takes a dive down to like 179 or something, they would get assigned shares at 180. So the thing is that in many ways, this is a strategy of someone who's saying, I like the name, it's overextended, so I'll sell a put spread on it. That way, if it takes a dive, I could get assigned. If it doesn't, then it does what I think, I'll make a little money. So it's a strategy that just kind of shows how big institutions use options sometimes. And I thought it was pretty interesting because from my perspective here, something like Apple, it's had this interesting run, but the earnings are on the 3rd of August. It's a long way off. And, it could be an area here where it just kind of doesn't do much for a little while. By the way, I'll just emphasize August 3rd is the earnings. The options expire the 4th. So it kind of makes sense that they're looking for that sort of thing. Say they come out with something negative and the stock dives down there, they might actually get assigned shares. And if it doesn't, then they just pocket a little bit of money and they move on. All right. So let me just look down the other items I have here I want to cover. What is a TS symbol for the 2-year? There is not one, I'm afraid. I don't believe there is. I've not been able to find. We have the 10-year and the 30-year, which is $TNX.X on the TradeStation platform. And then TYX, $TYX.X. I've never seen one for the 2-year, unfortunately. But if you're curious about it, you can actually, if you type in Fred 2-year yield, which is the St. Louis Federal Reserve data center, they have the data here if you don't have TradingView. I mean, I basically live on Fred, I feel like more and more because there's so much interesting stuff on it. I just take a look at this. Look at Fred CPI shelter. I mean, you can see it. My thing remembers this for me. Look at this. We go to edit graph. We go to percent change. And now look at what it's done. I mean, it's knifing down. And the thing is that, these things are, this is probably, going to continue when you look at the overall dynamic. The argument is there's a lag effect and the underlying data, the real data that comes from rent.com or these other realtors is going in a positive direction. And or not a positive direction. It's kind of rents have been easing. So if those guys are right and they've been right for 3 to 4 months ahead of the Fed or ahead of the CPI number, then there's a good chance that this is going to drag lower. It's a third of CPI, therefore it's not hard to imagine CPI continuing lower. So I want to just kind of point all these things out because from my perspective here, the easing of rates, the steepening of the curve, the strong advanced advanced decline line, all those things kind of just fit into the situation now of a low volatility kind of melt up stock picking environment. Low volatility is also good because it means options are cheaper, which is good for people like to trade options. All right, now some of the things that really stood out to me, and we had done this on TradingView also, was the dollar. And I don't want to get too much into currencies, but in my perspective, it's like the euro here, you have this clear kind of breakout. And a weak dollar, it's such it creates opportunities for things like global stocks. It creates opportunities for precious metals. And then for certain companies like Microsoft to do a ton of revenue overseas. So, you're talking here about something which is, I would just say it's really hard to imagine the S&P crashing when the euro's hitting new 52-week highs. To me, those things just don't go hand in hand. The correlation is very much the opposite. This was the bear market in equities, and it was also a bear market in the euro. Interesting that basically the euro bottomed like a week or two before, right there, the 13th of October. That's when the S&P bottomed. So, this thing's oozing higher, and that's pretty interesting. We had the weak payroll gains, we had the low inflation, and we had what's his name, Austin Goolsbee. He used to be in the Obama administration, and if you look here in the article I did on Monday, he actually had an interesting. He's now a Fed guy. I think he's at Chicago. This article here about Rivian, which I'm going to mention. But he actually said this thing. He said the Feds, we're on a golden path to a soft landing. What he said, it's kind of interesting. It was a CNBC interview he did on Friday. It's on YouTube if you want to check it out. I thought it's interesting because we had a lot of kind of hawkish people on the Fed before. Bullard, what's her name, Daly out of San Fran. We had Loretta Mester from Cleveland. They're all off the voting panel, and now we've got Austin Goolsbee, who is more dovish, and I think all these things fit together in that scenario. So it's interesting just to see right now that we're in an environment where the weak dollar is in effect, and that's kind of interesting. Let me also show you. There's another thing I have in my blog post today, but silver, I don't know, maybe it's kind of like the cicada bug or something, or it's a broken clock that's right twice a day, or silver it has these explosive rallies, and then it just is a waste. It's just dead money for months at a time. But silver could be making a move here, and if you look at it, silver is like your high beta version of gold, and with the weakening dollar, I don't know. Silver to me here is something that it can really move. And so I wanted to point that one out. There's a bunch of silver miners. Wheaton Precious Metals is the most liquid of them. There's an ETF tracking silver. There is the silver futures. But this is something that's pretty interesting. And I think right now, if you look at, there's actually a trend line here on the this is SI, which is silver futures, but I mean, purely obvious sort of pattern there. And I think we want to just kind of bear this in mind because, with a weak dollar trade, the euro's hit a 52-week high. Silver is still below where it was, back here. I think it's one we want to have on our list and be aware of. So what's also interesting is the kind of benign macro melt up environment. Let's take a look here again at, let's look at MTES. This is one that we've given you guys, but so the S&P is just continuing to kind of drift higher. I want to just kind of see what it was doing. But if you look back, well, I'm just noticing right now crypto, which is another thing that's been on my list. We did this thing. We recently created this MT hourly active. And we basically had said that Riot blockchain was a signal that we had, I think, identified here. And then we didn't talk about it at the time, but we said this was a clear signal using this new chart that I kind of created. And I like this. I've been using things like this in some of my own trading and my own idea generation. But, right now, Bitcoin is over 31,000 and Ethereum is starting to move. This is also something that would fit into that environment of the high beta, second tier kind of stuff that can start to explode higher. And the thing is Apple, Microsoft, these are the names then that kind of become dead money. And, you sell a little Microsoft to buy a little trade desk, you sell a little Apple to buy, your a little bit of Redfin or, a little bit of the other stock I'm going to talk about today, which is global e-commerce. That happens. And then, so I want to point out that that's kind of where we're seeing the lower, higher volatility stuff is really cranking. So that is one of the big themes I see right now. The weak dollar, lower volatility. This is a point where people are starting to get higher risk and pushing the envelope on stuff. And from my perspective, the Fed is on July 26th. We have a window here of about 2 weeks when that, kind of positive sentiment could last for a little while. So that's kind of the thing I'm looking at. Then the other thing is our individual earnings. So let me just quickly show you. If you don't know, I'm going to just open a new workspace here. I'm going to go to a new application. I think you guys know how to do this, but I'm just going to quickly highlight in case you're new and you want to see how it works. I'm going to open a new radar screen. I'm going to put in the NASDAQ 100. Go to data, symbol list, NASDAQ 100. I'm going to go to studies, add study, called next earnings date. Next earnings date RS, this thing. I'm going to just add that really quickly. And then I'm going to let it populate. So this, if you're new, just so you know, this is something that's built in the TradeStation. It might not be immediately obvious to you, but it allows you to track earnings and stuff like that. I'm going to add something else I've given you guys, which is average options volume. I like this. This will highlight. Wait, first I got to change this to daily select all. Change this to time frame daily. It'll reload, but this will allow me to just say, all right, let's find stocks that trade a lot of options and have earnings coming up, and we can see that really quickly. This is going to populate. So I want to just kind of warn against a certain pattern that sometimes pops up that I think we have to be wary of, and even a name like Apple might be falling prey to it. Now, I'm going to add MACD to this chart. I do like MACD because it can give like false signals a lot. It can give a lot, but I think the bigger question of when something is, kind of losing its mojo. One of the things that I've seen, and this pattern is common. I mean, Crocs is the one that springs to mind, but this has been on a lot of charts. This company had a strong earnings report with MACD falling, and it basically went about, it went about a month before it actually rallied. And we actually cited this as a long with a trading view idea, and we talked about it at the time. The reason is MACD was falling and the stock couldn't rally against the falling MACD. Then MACD turns up and you get the move. And then it had a bad report and blah, blah, blah. But the key point is this was the move that we look for. And the idea was let it run till earnings. We thought one good earnings will run to the next. And that's the thing. But here's the point. Buying the strength with the falling MACD, not a great idea. So when you look at something like Apple here, it's coming down off the top of the Keltner channel, but also MACD is weakening here. So the thing is, we could see, in my view, we could see Apple kind of just easing down. Strong earnings report gets sold. So I want to point that out. This is what we could see in some of these big names that have run a lot. Now, for an example, I'm just looking at Microsoft here, but today we had Delta Airlines, and basically, this thing it opened high, got hammered down. Now we have this big outside candle, but again, it ran on the news. So I want to just point out that I think right now we have to be careful of stuff because things have been running into the news. And, if something's run a lot and the news comes out, it might be too late. What could be interesting are names that have a really tight sort of compression that then explode higher when the results come out. And at this point, I'm not sure what those are, but we're going to be looking for those. Some of the ways to find those are things like, I'm trying to think of some of the patterns, some of the ways to scan it. I'm not prepared to talk about that now. I wanted to just mention that one of the things that I'm kind of, wary of are the names that have moved a lot. I don't think Delta's going down a lot. I don't even think Apple's going down a lot, but I do think that it could be a frustrating experience looking for some of these stocks, after earnings. I think a lot of them have run a lot. And the thing that immediately pops to my mind is the kind of, the weak dollar, the global trade. Those are the things right now that kind of present, a cleaner sort of opportunity. But then with individual earnings, there are so many companies that are going to be coming out, and some of those might have a pattern when it's a tight sort of move and then it explodes out. I'm trying to think of some. Was Palantir, did it do that? So look at a name like Palantir here, because at this point, when you look at it, when it reported earnings, like essentially, the MACD had already been falling. See, MACD is one of these things that it's good for a while and then it just doesn't matter anymore. It's meaningful like here. This is where you don't want to mess with it after you get the turn, and then it kind of just loses relevance. So like right here, Matt gives you good signals like right here. That's where you want to like chase the strength. But then at this point, it's like this is not invalidating the move. It just it'll kind of drift sideways for a while, and then who really knows what happens. The key thing is that initial thrust is the thing that matters, and very often you'll get another push. The thing you want to be careful of, see, this one had already been rising for a long time and then it shifted down. This one's been rising, it hasn't been falling that long. So my point is just that for something like Apple, it could have several weeks of falling MACD into earnings, and that could turn into basically a failed rally. And then a few weeks later, and don't forget September's when the iPhone thing comes out, that could be what happens. So it could be kind of a weak first part of August post earnings for Apple, and then the continuation. Now I'm not just trying to speculate on stuff. What I'm saying is the indicator that can guide you in that is MACD. All right, there were a few other things that popped up to me. Schlumberger had a crazy move, and Halliburton. So one of the things is there's an actual article, if you Google, I think it's on oilprice.com. If you Google Rystad Energy and this term well intervention. So apparently this is something they do with an oil well when they get into a well and they do a bunch of stuff to it to make it more productive. The key thing is who does that? Schlumberger does it, Halliburton does it, Helix, HLX do it. And these kind of companies can, there's the potential here. What I'm seeing is oil industry insiders are seeing some kind of secular opportunity for oil field service stocks that deliver this thing called well intervention. So I want to just point that out, because going into today, some of the biggest gainers so far this quarter were Schlumberger, Halliburton. It's just kind of interesting to me. I think I mentioned that here. These guys are leading so far this month. And it's under the radar, but again, with the dollar, weakening and this global thing coming to life, that's the environment that can favor energy. And don't forget, we have these really tight inventories here, and the non-recession now that people don't expect, all of that can be favorable for energy. All right, let me just see here. Okay, very interesting, this thing about Microsoft and Activision, where basically the Federal Trade Commission really got slapped down by the courts. And there's been a lot of it's pretty interesting to think about this market, because M&A has not been much of a driver. But there is this sense here that the FTC might be finally kind of getting knocked back, and we could start to see more M&A. So that's something else that's out there, which I think is interesting, because if we look here at our MT main and we look at our indexes, and we look here at the small caps, we actually can see that the small caps are actually starting to do pretty well and kind of gain. Now, this is the way we use this. You can see in the last 63 days, which is 3 months, 363 calendar trading days, not calendar days, you can see that IWM and the small caps have been pretty weak, but they've been outperforming the SPY and the Qs in the last 2 weeks. So we're seeing this is telling us that in the short term, they're gaining versus a longer period of weakness. This tells us there's something of a shift here. So I wanted to just point that out. Also, gold mine. I'm not saying, I'm not sure to make a gold miner here, but it is interesting to see, there's another weak dollar trade. It's been dead money for it's down in the last, 3 months. And here it is ripping in the last week. Near term, you can say gold miners overbought. But I mean, this is also just kind of interesting. And this is the way I kind of look at stuff. You see the rotating sort of areas of strength. But my point about M&A though is that if we see M&A, that's something. If we see the government start allowing more M&A, or there's a belief that M&A is going to come back, that could ignite small caps. Also interesting, the Citi downgraded the United States and upgraded Europe. Also fits into what I'm saying. This is U.S. market versus European market. It fits into what I'm saying. Now, remember, if we go over here to our MT sectors, all right, and you look at EFA is basically the global ETF. If you want to see, by the way, standardized returns for these, it's in the this tab here. It is available. This basically shows global stocks versus the S&P. And what we can see here is that, it's been a pretty bad, 15 years for global. They've been, I've talked about this a lot. The key thing is that there's a lot of potential here for global to play catch up. The EFA is well below where it was, in 2007. If you look at the VGK, which is the European, ETF from Vanguard, it is also well below where it was. So a lot of these have, the potential for a period of catch up. And I wanted to just point that out because, I think this is something that it's, when you get multiple kind of signals pointing in the same direction, Citi says it, then the Fed pauses, then the euro breaks out, you can start to see a pattern coming together of the dollar weakness and the global opportunity. By the way, I was looking at Deutsche Bank recently. I don't know what's really happening with their business, but I mean, look at this tight pattern in this level here, right? Kind of under 11, around 1080. This to me looks kind of interesting. I mean, I want to just point that out. I've been watching some of these European banks, and we've been mentioning for a long time the opportunity. And I mean, these are not heavily traded, but they've really done well. BBVA, Santander. We've been mentioning these. We wrote about HSBC, but I mean, these European banks have actually done very well, and Deutsche Bank has not. And I think this is one here where this is a tight little pattern that will it follow its peers higher now that the euro is hitting a 52-week high. I'm not sure when the recording will be available. All right. There's been this move in Meta because of Threads. I mean, it's moved so much at this point. I'm not sure what to say on it, but it's really been interesting. The one that did stand out among these big names recently to me was Netflix. It also has this gap here that's kind of interesting. So we had talked about, looking at option spreads, and this is one also where they report earnings. This is a classic example. They report earnings on the 19th. So let's take a quick look here at the Option Station Pro and see if it might pop up on Netflix. For people looking for, say you think, oh, it's going to explode higher, buying a stock like this and being wrong can be, a good way to lose money. But people looking to manage risk with options might find some opportunities in a name like Netflix. It trades a lot of options. And we know when earnings are. It tells us right here. It tells us on the 19th. So we want to look for, this week here. And, a person might say, well, I think it's going to break 450 and jump to 500. So if we were to look at this options, these, we can see here that a spread of that would cost about just under $20. And then you'd pull in a credit of about $5. So the cost of the spread is about $15 for a spread that can expand to $500. So a person can set that up by changing this to vertical, right? And then you want to actually see, let me just count 1, 2, 3, 4. See, this the width. You have to see how wide. That's the one thing sometimes you got to actually see how wide their spreads are. But you can look at 450 to 500. See, it costs just under $15. And that would be a trade that has a potential risk reward of, more than 3 to 1 sort of, potential reward. So that's the sort of thing that people can look to do using Option Station Pro. And the other thing is, a person setting this up, they could go in here and say, well, I'm going to put in a bid of like $14. And sometimes it flips around a little bit and boom, you get filled. And then it's that simple. So this is the time now to be starting to think about things like vertical spreads. And in fact, just to let you know, I'm going to be doing a special webinar on the 24th, Monday afternoon at 3 p.m. when the markets opens. Hope you guys can join me for that. Specifically about using option strategies with the big week that is. That's right before Apple and the other big names report. You know, it's interesting. Rivian actually became the #2 most popular symbol at TradeStation after they reported those strong numbers. And it is interesting to look at a name like Rivian, how it's really come to life. And, you know, Tesla has kind of sat as well. But I would just emphasize that if you look back at Tesla in October of 2019, they reported similar news about how they were fixing their manufacturing. And then basically, you know, the stock just didn't look back from that moment. So, I mean, I think we have to realize with Rivian, I know, you know, a guy who used to work there, and he, you know, people say it's, you know, really great truck and all that sort of thing or whatever it is. But the thing is that there was always this belief, oh, you know, it could be an awesome stock when they finally get their, you know, their manufacturing in order. Well, if they finally have it in order, people have a template to work off of. And in some ways, the fact that Tesla went first makes it one of these things where everyone who missed Tesla, you know, can now look to Rivian. So I think this is a name that needs to stay on our list, you know, to think about different opportunities in it. This is a name that could work for, you know, with our new, what do I call it? MT hourly. I can't remember what I called it. You know, a name like Rivian here. The way this indicator works is, you know, you look for something where it would pull down the Keltner channel. So the Keltner pullback on this, let's see if is Rivian on this. I don't know if I put it on here. Let's put it on. Now I'm going to add it. All right. So the way it would work is if it takes a dive down to this level, what would happen is the Keltner pullback would turn green and it would show a level kind of closer to 0 or under 0. And that means that it's pulled back. So look here at CCL. This is under its Keltner channel. And that's a signal. Now, let me be clear, though. The reason that we use something like this, and this is what I mean about MACD. The first thrust can really be nice. But once you get that second, you know, that first pullback, all right, that's fine. We'll ignore that. I mean, that's the first one doesn't invalidate the trend. But this is the point where MACD actually is telling you it's tired. It's usually that kind of that second cross. And that's what we have here. This is what the MACD does. It's basically, I took just the blue line on MACD and I extended the time frame so that it emulates the same behavior of MACD on here, on the daily. You'll notice the time frames are different. Actually, you know, I made a mistake. Let me apologize. This should be teal, not blue. Cyan, I'm sorry. Change it to cyan and then save it. I apologize. That way it links up to MT main. I did the wrong color for the symbol linking. But anyway, you can see here, if you look at something like, let's look at a name like Google or something. I mean, you can see here that this MACD, this is a bearish MACD signal because it's just been bleeding down and down. Then look at this over here. You can see that it also on the daily. So this is this thing where I basically set the hourly chart to behave. I set one part of the hourly chart to behave like the daily, but the RSI is not. So this is like, this is not a bearish signal really, but this is not a buy signal because you have overbought RSI and then you have this ugly effect. So this is one here where, you know, a pullback and then the cross of the 50-hour above the 100-hour would be the kind of signal we would look for. The last time we did this webinar, we said that this workspace was flagging. We said the best opportunity it was flagging was JP Morgan. Based on this, we said that when you have the MACD turn up like this and the RSI pulled deeply down, it was also basically down around its, I'm trying to see, last time we did the webinar was on the 6th. That's right. It was right here. And it was under the Keltner channel. So the Keltner reading was negative. The RSI was like under 50. So we have this set up so when RSI goes under 50, it'll show up as being oversold. because when something's trending higher, RSI generally doesn't go much below 50 when something is in an uptrend on the hourly. That's what I've learned. So anyway, this was a bullish signal that we identified last time as a buy, and it did perform the way it was expected to. And in this case, as I'm looking at this though, you might be tempted to say, oh, Carnival looks good, but see this, there's a big difference, in my opinion, between this, which is tired, so tired, yawning over, and then and what JP Morgan was, because JP Morgan, you could see at that moment it kind of had that sharp rise. And what I really like to see is when this is shooting up and this is shooting down. The RSI is dropping, but that hourly MACD is rising. To me, that's the classic signal. And if you look back at when Riot gave that classic signal, it was a similar sort of thing. RSI dove as MACD was ramping. That's the signal that if we can see it, I don't see it on anything right now on this chart, on this workspace. Let's take a look at AMD though. The AMD is starting to show that the MACD is just starting to get nice, just starting to get to rise. But you also don't have anything. In my view here, we want to be watching the breakout of this potential sort of line. If we get that close up here, kind of above that 116 area. Okay. Netflix, I talked about. Home Depot is one we had talked about a lot. Just trying to see here. This is not on my list of active traders, but this one is also getting in that sort of, ballpark of the sort of thing that people kind of want to see. This is actually one that this could be starting to get in that sort of position, because you basically have, it's down near the bottom of the Keltner channel. If we actually just go here and add Home Depot to it, you'll see the Keltner pullback is green. The RSI is kind of getting down toward that area, and we have the good sequence of the moving averages. So this one is kind of getting there. MACD has been kind of just trundling higher. All right, let me just go back over to my rundown if I'm missing anything. Let me know if you have any questions, because I'm almost done. The webinar is going to be on the 24th. I don't know, Manolo, if you can share any details on it. Put it on your calendar. It's 3 p.m. on the 24th. It's going to happen. I'm not sure when they put that up. All right, so if you think, I want to just point out, all right. All right, so basically, I don't want to get into politics or anything, but I think it's interesting to look at this right now. United Auto Workers are making a big noise with GM and Ford. United Parcel has issues. Amazon has potential union issues. Now, which part of the Democratic Party voted for Trump in 2016? A lot of union guys, a lot of auto workers. I see a little bit of a risk here of, there being a kind of pro-union swing. And I'm not against unions. I'm just saying that we could be at a spot here where the unions start to kind of fight back. We have a tight labor market. Biden would probably want to be, taking some of those blue collar votes and the unions and stuff. And, I just want to point that out from my perspective here. And I'm not trying to make a bet on politics. I'm just saying is union agitation and labor unrest is not an issue we've seen a lot of. And when something starts, I get wary. It's when something is a known story that you can kind of say, oh, it's priced in. I don't think union agitation and strikes or whatever they do is yet an issue in the market. I don't think people are pricing it in. And I think as people start to price that in, it's bad for GM and Ford, and it's potentially problematic for the others. I want to just point that out. I see this as being something that is an emerging danger. And, I'm not anti-union or pro-Biden or anti-Biden or anything. I'm just saying that you can see where it makes sense. And I want to just point that out because this is the thing that's lurking under the surface. The same way the M&A story is now lurking as a positive, the weak dollar is lurking as a positive. The union thing could be lurking as a risk for a select set of companies. As I was interviewing Tom Lee, who has a similar mindset to me. You see him on CNBC sometimes. he basically saying people are chasing the new highs. And, I watched CNBC, I'll just say, during CPI and kind of know what's going on. Kramer, whatever. I mean, but it's interesting. He was saying the same stuff I said about factory construction. I talked about this like 2 months ago on this webinar, how we had unprecedented investment in domestic factory production. And now Kramer's talking about it. And then I've seen her on Yahoo Finance in the last couple of weeks. So I want to just point out, we've been able to get ahead on some of these things. All right. Also, it's interesting. I saw this weakness in corn futures, but again, this is deflationary. I mean, obviously, corn and stuff is not that important, but it does filter through to other things in the economy. We've had actually, I mean, apparently a really good like growing season and stuff. So it's just something else to kind of bear in mind. All right, let's take a look at just a few of these other things. First Solar. This is one of these companies that people said is like, such a great name, and it's this heavy focus on the domestic production of solar panels and the Inflation Reduction Act because it's American and not, but anyway, this name has basically gone nowhere for a while here, and here it is getting back above the 50-day. This is to me kind of interesting, and I think this is one that this one popped up on some of my scans. Another one, I mean, this one already moved, but Shopify. This was one where, what do we see? We see these higher lows above the 50-day moving average, something of a triangle. V-Shop. Now, I have been pretty negative on China. I've been pretty vocal about this on this webinar. I more or less stand by that. I think that, they're going to have trouble, but the key point is we have now entered a period of global strength, dollar weakness. So I'm not going to be stubborn anti-Chinese stocks. There's a lot of really interesting growth stocks in China. And the thing is if we're at a point now where the dollar is weakening, the Fed is pausing, the global stocks make more sense. V-Shop holds the 50-day. To me, this is a sort of thing that can extend. It's basically gone nowhere. I mean, it's like, look at it since the beginning of the year. I mean, it's kind of had this decent rally, tight consolidation, breaks above, holds, and I wouldn't be surprised. Let's do a Fibonacci retracement here, drawing Fibonacci price retracement lines. Take a look at this. Boom, boom. Pretty much your 50%. It held. That's what people want to see. So this is just, to me, a name that just kind of pops up, and the 50 is above the 200-day, unlike a name like Baba or something, or a name like JD, which has been, sucking wind. V-Shops was one that popped up on my list. I did a scan for stocks that had recently touched the 50-day moving average and had the 50-day above the 200-day, and there it was. No, actually, I think I might have spotted it because it had a new 52-week high there. But regardless, that's the other one that kind of popped up as a potential signal. All right, so my mover of the week is Global E Online, GLBE. They actually have a partnership with Shopify of some kind. This company apparently does stuff. So if you're like an e-commerce company in Africa or somewhere, they focus on the global e-commerce. And but the thing is, if you look at their estimates, I mean, they're really significant revenue growth that's being projected for them, and they've been sticking with it. So again, high multiple growth stock, trades like over 10 times revenue, but falling interest rate environment, lower VIX, global strength. This is the environment for names like this. And I'm telling you, there were a lot of IPOs, and we've talked this a lot. There were a lot of stocks that went public 2019, 2020, 21. A lot of them got hammered lower, and now some of them are coming back, and Global E was one of those. So I want to just kind of mention that. This is one that popped up on my list. It's also a non-index member. And I think now, if, for fast, active trading, these highly liquid names with like this kind of approach, with this hourly active chart, this is the sort of thing that I look for the kind of fast, active trading and stuff. We might get another pullback here in energy. I'm not sure. I was just kind of watching this, but that's for your short kind of, momentum trades of a few days at a time. But, for longer term growth sort of part of your, portfolio and things like that, people, I think, are going to be looking to these non-index members. These are the growth stocks now that are in that kind of sweet spot of going from small to large, and they're in that middle. And those are often your opportunities where they're proven enough that people will believe in them. They have some analyst coverage, they have enough track history, but they're not yet. I mean, Trade Desk is not yet, it's not yet Salesforce.com. It's in that happy middle. And that is, I think, right now where I'm seeing the outperformance. All right, so just remember, as you look forward, next week is housing week. Tuesday, Wednesday have the housing numbers. Housing starts building permits, and then we have the home builder sentiment. The big banks start reporting earnings tomorrow. Those are the main sort of things out there. And the Fed, of course, is going to be on the 26th. So that's just kind of a drift into that. But now it's all about earnings. And I just go back to the point. One of the things that actually popped up here, I think I have this here from FactSet. They made the point, more companies are issuing positive guidance than normal, and downward earnings revisions are smaller than average. So, a lot of these little bits of data here and there are better than expected. And the other thing I'll mention, the first two companies, the big ones, Pepsi and Delta, both had strong guidance. Well, guess what? I've been saying all along, the full calendar year EPS growth of 1%, it's been at 1% for like several months before NVIDIA hiked, before these guidance raises. So what happens when the investors say, oh yeah, I mean, Wall Street, when the analysts say, oh yeah, maybe we should raise our estimates. My expectation is that there's a decent chance here that we are going to see these guys are going to quietly, they don't want to say they were wrong, they're going to quietly start cranking up the fourth quarter and the third quarter estimates. And it's going to be a little bit here, a little bit there. It's going to make this trickle of news. And then before you know it, we're going to be looking at like 3 to 4 to 5% for the year. And then suddenly the S&P doesn't look as expensive. And that's, I think, what we're in the process of seeing here. So it's great to talk to everyone. We're not doing a webinar next week. I'm off, but I will see you the week after that. I hope everyone has, and don't forget, so the 20th, no market trends, but the 24th, we have the Monday, the 24th at 3 p.m. We're going to have the earnings, and then the 27th we'll be back for market trends. Go ahead and check out Market Insights. And if you have any questions, you can always contact me at DRussell@TradeStation.com. Thanks for being with me, and I'll see you guys a couple weeks.